All right. Good morning, everybody. It's 10 o'clock, and here we are. 10 o'clock on Tuesdays. It's time for our Tuesday weekly webinar. So this is a live webinar, so sometimes you get the benefits and the drawbacks of being live. Sometimes you hear me say things and I'll laugh about it, but we'll edit those things out of during the editing process, and then we send out recordings so that you can watch them without some of the silliness sometimes. But we're also during the recording. So if you're not on my email list, then and you want to be and receive those recordings, or if you should subscribe, you should hit that subscribe, like, and notification button, so that you get the notifications when we publish the recordings. Because we do a couple different things with the recordings. First of all, we index them so you can choose the section that you want to hear. We have a process for these weekly webinars, and that is we first go through some updates, maybe some things that are going on with the firm or some big headlines, upcoming events, things like that. And then we'll go through the Ed Slott information that we get from the Ed Slott group, and that lasts about 15 minutes or so. And then we talk about the markets for about 15 minutes, and then we do our Financial 15, which is a financial planning topic. So that there may be part of this webinar that you'd prefer to hear over the other, and on the recording you'll see that indexed. In the recording you also see links to any other videos that we have that I might mention during the broadcast here, or other resources. So it's good to watch those recordings and pay attention to them. Then we also completely separate out the Financial 15 portion and sometimes divide that into two portions. So like last week's webinar was about the updates to the 2024 tax brackets, and that became two Financial 15 segments. So they're listed separately on our YouTube page. So it depends on what you want to focus on. It depends on how much time you want to spend in the webinar, but a lot of different options for you. So again, welcome everybody. This is the last one of January. It's January 30th, just one more day of January, but certainly our last webinar. So we do have a couple things coming up. So tonight starts the first in our 2024 series of the Changing World of Retirement Planning classes. And it could be called the Challenging World of Retirement classes, but it is a Changing World of Retirement Planning classes. And that starts this evening. We have a huge class, 90 some people, almost 100 people registered. It's a webinar, so no limits on the amount of registrations, and it's kind of interesting because we're getting registrations from all around the country, and my wife helps me with these registrations, and we've been talking about where they're coming from. So it's quite interesting. So people are receiving their invitation and sharing it with folks around the country. So that starts this evening. We have two Tuesday classes, January 30th and February 6th, and then two Thursday classes, February 1st and February 8th. Each class runs 3 hours long. So that's 3 hours tonight, 3 hours next Tuesday, 3 hours Thursday, 3 hours next Thursday. There's a lot of great information in this class. I can objectively say that. I did not write the material, but I think it's the best retirement planning class out there. So if you're not registered, register. If you've heard it before, feel free to join us again. We won't be able to get your workbooks in time for the first class, but you'll get, if you haven't attended the class before, you'll get workbooks. So that's what's coming up. Also, what's coming up is I told you that I guess it's been a few weeks now, but Dave McKnight contacted me and said, "Hey, Mark, would you mind doing another podcast with me?" He told me that the podcast that we did together last time had the largest number of hits or watches on his YouTube channel, so he wanted to do another one. I always love an opportunity to talk to Dave, and I shared with you before that a week or two ago I was in, I guess 2 weeks ago now, I was in Arizona with Dave and his entire group at the Power Zero conference. So that podcast should be hitting soon, and I'll let you know when that's available. I think that he's going to break up our hour-long conversation probably into 4 or 5 segments. But I'll let you know, and you should definitely subscribe to that Power Zero podcast. It's really great information. Dave does a great job as always. So today in our Financial 15 segment, we're going to talk about the 2024 IRA and Retirement Plan updates. Again, last week we talked about tax bracket updates. This week we're going to talk about IRA and Retirement Plan contribution updates. Next week we're going to talk about the IRMA, income-related monthly adjustment amount updates. And the next webinar we'll talk about the Secure Act, things that are coming into play with the Secure 2.0 law that triggered updates in 2024. So a lot of new things in 2024. So let's go into our section, our Slott Updates section. So I'm going to share my screen with you so you can read along. And this was really timely. I think Ian might have heard me say last week that we're going to talk about retirement contribution limits. So he went ahead last week and prepared this report. I don't think that's true for a minute. Ian, I don't even know if Ian listens to our webinar. He might. So we're going to talk about this report, this piece from Ian Berger from the Slott Group, and that is how contribution limits work when you're in two plans. And he also touches on the aggregate amount of contributions and some really good points here. So let's just go through it. The start of the new year is a good time for a refresher course on the contribution limits that apply when someone is in two different retirement plans at the same time or at different times within the same year. For example, after changing jobs. The rules are challenging because there are two different contribution limits to worry about: the elected deferral limit and the overall contribution limit. So let's first talk about the elective deferral limit. The elective deferral limit is the maximum amount that an employer can defer in any one calendar year. The limit is based on the total pre-tax and Roth contributions made to all 401ks, 403bs, and simple IRA plans, but not 457b plans. During the year, deferrals to all plans are aggregated, even if the plans are sponsored by companies considered unrelated under the tax code. For 2024, the effective deferral limit is $23,000 or $30,500 if you're age 50 or older. So that last sentence is a little bit confusing. So it's $23,000 if you're under age 50. If you're over age 50, it's $30,500. So that's the amount that you can put in to the 401ks, 403bs, and not a simple plan. Simple plan is a little different, but that's the maximum deferral limit. So here's the first example. Kyle, age 48, has a regular job with General Hospital that sponsors a 403b. And he also has a solo 401k through a landscaping side business. The most that Kyle can defer between the two plans for 2024 is $23,000. Why $23,000? Because he's under 50 years old. It doesn't matter that General Hospital and the landscaping company are unrelated businesses. There are two important exceptions to this rule. Traditional non-Roth after-tax contributions, if allowed by the plan, don't count towards a $23,000 or $30,500 deferral limit, although they do count towards the overall contribution limit that he's going to talk about below. And 457B plans have their own separate limit. This can be a windfall for employees like hospital executives or high-ranking medical staff who are eligible for both a 457B and a 403B plan. They can defer up to the maximum deferral limit for each plan. 457 plans are also popular in government agencies. I have a lot of, many of you know, I spent 21 years in law enforcement. I still have many, many friends in the law enforcement community, and many of those folks have 457 plans. So that's really it's a structure kind of all on its own, and you can really, especially in the last few years prior to retirement, you can put a lot of money away into those. Okay, so overall contribution limit. So you've got your elective deferral, and then you have your overall contribution limit. So the overall contribution limit is sometimes referred to as the annual additions limit or 415 limit. This limit is the maximum amount of all contributions that can be made to a plan by or for any employee in any year. Both the employer's own contributions, pre-tax, Roth or after-tax, non-Roth, and the employer's contributions, matching or non-elective across the board, are counted. For 2024, the overall contribution limit is $69,000 or up to $76,500 for 50 or over extra deferrals are made. So again, if you're under 50, $69,000. If you're over 50, $76,500. Special aggregation rules. Let me just move this up. Special aggregation rules apply. Generally, contributions made to two plans sponsored by the same company or different businesses considered as one by the IRS are combined for the overall limit. Aggregation doesn't apply if one of the plans is a 457B, and usually doesn't apply when the two plans are a 401k and a 403B. Yes, it's complicated. That's why you have to have an experienced and knowledgeable advisor who helps with these things. But if someone is in two plans maintained by two separate companies, or if someone is in two plans maintained by separate companies, for example, contributions generally aren't combined, and the employee gets the benefit of a separate overall limit plan for each plan. Aggregation does apply if both plans are 403B plans. Yes, it's confusing. So General Hospital and Kyle, here's example number 2. General Hospital and Kyle's landscaping business from example 1 are considered unrelated businesses. So for 2024, Kyle has a separate overall limit for the 403B plan and the 401k plan. It could theoretically receive a total of $138,000. It's $69,000 times 2 in combined contributions. Although practically that would be difficult to achieve, Kyle's combined pre-tax and Roth contributions between the two plans would still be limited to $23,000. So what he's basically saying is, while it's conceivable that Kyle could go up to $138,000, the difference between $23,000, his combined contribution limit, and the combined overall limit would all have to come from employer contributions. Oh, thank you. First of all, Doug says hello. Doug always says hi. I appreciate that. Good morning, Doug. And he says we can hear fine. I'm still getting an error, so that's really helpful. This is confusing stuff. I understand, but people do try to game these systems, and you run into problems. People try to, I refer to it as kind of trying to get cute. People try to say, well, if I have two different businesses, and even though I own both businesses, if we split it up, I can contribute maximum to a 401k here and a maximum to a 401k here. The IRS is wise to these things, and certainly they have reviews for common ownership. But even if they're two separate plans, well, I just read the rules. So again, you've got to be careful, because sometimes what happens is you roll through and you make these contributions. Your provider shouldn't allow it, right? And there's testing to be done and things like that for not just for incomes and top heavy testing, if you're familiar with what I mean in a retirement plan, but also for common ownership, things like that. But sometimes you can slide through the cracks, but not for long, folks. And all, there's penalties involved. All that money has to come back to you. So it's don't try to get cute with these things. It's complex stuff. All right, the next is also by Ian, and this is the mailbag. So these are questions that come into the Slott group, and an analyst like Ian or Sarah or Andy or Ed will answer these questions. Backdoor Roth IRA conversions and the annual RMD requirement. Today's Slott Report mailbag by Ian Berger. So the question is it possible to do a backdoor Roth IRA conversion with a SEP IRA? If yes, how does it work? Thank you. So what is a backdoor Roth IRA conversion or a backdoor IRA Roth contribution? I kind of like the phrase, this backdoor Roth IRA conversion has gotten more popular, and I don't really know why. I'm sure there's a reason behind it, but what it really is a backdoor, because you can convert money there's no limitations on conversions. There are strict limitations on contributions and to a Roth IRA, and that has to do with income and amounts. But what these backdoor Roth IRA conversions are talking about is really a backdoor way to it's a backdoor way to contribute to a Roth IRA when you're unable to contribute to a Roth IRA regularly. And we're going to talk about those limits during the Financial 15. But so I don't know why this term has come about. It's probably a question I should ask Ian, since he just wrote about it. But it's really a contribution. So it's a way to move. And I have a video about this, and I'll refer to that in the notes. Backdoor Roth. All right, and I'll put that in the description. But what a backdoor Roth contribution is that if you're over the limits, your income limits, to be able to contribute to an IRA, it allows you to make a non-deductible contribution to an IRA and then convert that money to a Roth IRA. There are a lot of rules around it that you should pay attention to. One of them is the pro rata rule, which means you've got to be careful of how much money you have in your collective IRAs. traditional IRAs, because that will affect the amount that you have that you can directly convert without paying tax on that money. So the answer to this question is yes, you can do a backdoor Roth IRA conversion with a SEP IRA. You would simply contact the IRA custodian and request a conversion. If the SEP IRA is pre-tax and you have no after-tax IRA funds, then the converted amount is fully taxable in the year of the conversion. If you do have after-tax fund, a portion of the conversion is tax-free under the pro rata rule. Next question. My mother was taking required minimum distributions, RMDs, until she passed in 2023. Her 3 children are the beneficiaries of her IRA. Do the children have to take annual RMDs, or can they take distributions anytime during the 10-year period as long as all monies are removed before 10 years? I've gotten several answers on this. So that last sentence there struck me. I've gotten several answers on this. So these RMD rules are just more and more confusing. Sorry, I'm trying to highlight that for us. More and more confusing every time Congress touches the tax code. And they've gotten extremely confusing for professionals even, and certainly individuals, with the changes in Secure Act. And there's a lot of webinars out there that talk about RMDs, and I happened to watch one, and their information was incorrect. So you have to be careful the information you're getting. And, that's why, you've got groups like the Slott group that specialize in these things. So here are the answers, or the answer to this question. The rules are confusing, so we're not surprised you've gotten conflicting answers. The IRS has said that beneficiaries subject to the 10-year payout rule, like you and your siblings, must take annual RMDs during the 10-year period if the IRA owner died after starting their RMDs. Because the rule surprised and confused many people, the IRS waived those RMDs for 2021 through 2023 for beneficiaries in this situation. I want you to consider that for a second. The IRS messed this up so bad that they said, you know what, we understand that this is confusing, and we understand that this that we keep giving, or we had in the past given conflicting direction, so we're going to waive these penalties, which means you really don't have to take the RMDs when the penalties are waived. And they did that in 21, 22, and 2023. Who knows if they're going to do it in 2024? Ian goes on to talk about that, but we'll see. We'll see what happens. It's possible the IRS will do that again for 2024. So you and your siblings should wait until later this year before taking the 2024 RMD to see if it's waived. So that's good advice. The problem is that some people want to take their RMDs earlier. So we have to wait around sometimes for the IRS to get their stuff together. All right, so moving on, let's talk about the markets. So the Dow Jones Industrial Average was up last week, about 0.65%. Year to date, 1.20%. So this is as of January 26th. It's closed on Friday prior to this webinar. The S&P 500 was up 1.07%. That's 2.62% for the year. The NASDAQ was up 0.94%. That's 2.98% for the year. The MSCI World Index, that's collectively large economies, but not including the U.S., was up 1.93%. That's down 0.6% for the year. Emerging markets, so that's smaller economies around the globe, obviously not the U.S., was up 1.47%, but is down 3.73% for the year. And notably, the small cap index was up 1.4%, but is still down 2.24%. Bonds, the bond index was up 0.10%. Bonds are down for the year. So I talked about this a lot last year. This U.S. aggregate bond index, which is where most people have their money, most bond investors have their money, and that's about a 7 to 9 year maturity or duration, I should say, of these bonds. It's how long these bonds typically live in these portfolios, or that is how long the bonds are set to either be called, matured, something like that. That's what duration. That's a really broad definition of duration. Probably not a great one, but that bond index is down 1.3% for the year. Interest rates are down likewise in certain parts of the curve. So the 2-year Treasury was down slightly last week, 4.35%. The 10-year Treasury was up slightly, 4.14%. The 6-month Treasury was down 5.21% compared to 5.22%. I'm sorry, when I'm saying that they were down, I say it was down 4.35%. It doesn't mean that the 2-year Treasury was down in value 4.35%. What I mean is the yield is as a close of 1.2 or January 26th was 4.35% compared to 4.38% the week before. Just for clarification on that. So just a little bit of movement in interest rates, nothing really aggressive. Okay, so let's move on to our analyst report. So the GDP, last week, the gross domestic product report came out. The U.S. economy posted a 3.3% annualized growth rate in the fourth quarter, higher than 2% growth expected. The analyst writes, this report looks in the rearview mirror and is often looked past by equity investors, but the strong reading could be further support for those Fed members wanting to hold off on reducing rates. So this is a big topic this week. So the Fed makes its statement tomorrow. We'll see what they say about their rate decisions. But what the analyst is saying is that this could support them wanting to hold off on reducing rates. Everyone's expecting rates to be reduced at some point during the year. Different analysts are saying different things. Probably in the later part of the year, maybe as early as June, but and maybe not at all. Maybe not at all. Maybe we just kind of stay where we are for now, depending on what happens. Jobless claims came out last week. This forward-looking labor report showed initial claims moving higher by 25,000 to 214,000, but the 4-week moving average, so where they were over the last 4 weeks, obviously, which smooths out some of the volatility, decreased by 1,500 claims to 202,250. The analyst writes, the labor market continues to look very healthy, leading us to believe that the Fed will be patient in reducing interest rates, as there are few signs of the economic need to do so. The big one last week was the PCE index, or the Personal Consumption Expenditures Index, which is a measure of the prices that people living in the United States or those buying on their behalf pay for goods and services. So I always like to talk about that because most people know what CPI, Consumer Price Index, means. But we throw around these terms like PCE, and that's the Personal Consumption Expenditures. And this one is arguably more important to the Fed than the Consumer Price Index. The inflation gauge rose 0.2% in December, up from the 0.1% decline seen in the month prior, and was up 2.6% year over year. The core rate, which excludes food and energy, also rose 0.2% month over month, but gained 2.9% year over year, down from the 3.2% rise seen in November. So what does that mean? It means inflation continues to show moderation, but remains above the 2% target that the Fed has consistently stated as their goal. The committee likely won't wait until inflation reaches that point to start cutting rates, but the voters may want to see a bit more progress before easing. Now, when they talk about the voters, they're not talking, we're in election year, so we're not talking about us as voters. We're talking about the Fed committee as voters. So what's coming up this week? We have earnings this week, including Apple and Microsoft, but the big one for this week is Wednesday, tomorrow, the Fed rate decision. No rate change is expected, but the statement and accompanying press conference will be closely watched for clues to when cuts may be coming. Thursday is ISM manufacturing. We'll see what that looks like, and then a labor report on Friday. But overall, just a modest week, as I reported last week. Just slight changes, but we'll have to see what happens going forward. And I'm going to read to you I'll read you what Goldman Sachs said. It was a lot of nothing, in my opinion, but and I respect their analysts. But let me read to you first. BlackRock. BlackRock wrote, I think it came out yesterday. Excitement over artificial intelligence spurred a rally in U.S. tech stocks that buoyed the market in 2023. We've said the rally can run for now and broaden out. Why, they say? Inflation will likely near the Fed's 2% target this year, and the Fed is set to start cutting interest rates. So we upgrade broad U.S. stocks. Our index level view plus all artificial intelligence theme preference. Their preference is you. This is BlackRock. I'm reading you BlackRock's opinion. This is not a endorsement of BlackRock. It's not a suggestion to buy BlackRock. I like to show different analysts' takes on things to give you some idea of where the big thinkers are coming from. So they're upgrading U.S. stocks that are focused in the AI industry because that's where they feel the most of the growth is coming from. So they were going to overweight on a tactical horizon of 6 to 12 months. So what does that mean? So tactical investing says we're going to overweight or underweight certain positions or certain sectors because we think they're going to be doing better over a shorter period of time. And nobody can argue that 6 to 12 months is a shorter period of time when you're talking about investing. I'm not a tactical investor. I'm more of a strategic investor. And we talk about that. Here goes another video. I'll post this in the comments, but the difference between strategic and tactical investing. So that's BlackRock. Now, what did, and I'll just share with you because I just kind of think it's funny, but what did Goldman Sachs say? Yeah, here's what Goldman Sachs stated on Monday. We head into 2024 more optimistic on the state of the global economies than we were entering 2023, but that alone does not signal a full risk on tilt. What does that mean? Just being heavy in the stock market is full risk on. Tail risks persist, and a wide dispersion of views may create attractive entry points across asset classes. A growth slowdown coupled with select U.S. markets pricing and optimism informs our belief that idiosyncratic investing with heightened risk awareness is paramount for navigating the next investment cycle. Importantly, we expect duration to be a key driver of returns, and we find that a balanced portfolio of equities, fixed income, and alternatives may hedge against broad risk. Well, I think that's good in almost any market. So I appreciate them saying that. No real insight on what they're thinking. But how do you manage these things? You've heard me say it a million times. First of all, you have to have a financial plan. Your financial plan has to drive your investment decisions. Those investment decisions should be based on, should be acted on based on the 3 pillars of investing I talk about. And that's asset allocation. Strong asset allocation has to be a key component of that. And that's determining how your investments are allocated. We've all seen the pie charts, and that you've got the best pieces of the pie chart running for you in your allocation. So what I mean by that is, don't hold the same fund for the last 30 years only because it's comfortable and you understand it, or maybe you don't understand it, but you've always had it. There has to be a good reason to have that investment manager or that investment component in that pie chart. There's got to be a good reason for that, and it should be that maybe they outperform or they have lower costs or both. That's ideal, right? They have a tendency to outperform and they have lower costs. But make sure your pie charts, your segments of your pie charts are in good working order and optimized the best that they can be. So that's asset allocation. Principal protection should be a part of it for most people. So that studies have shown that beginning at 1/3 of your assets held in principal protection helps tremendously when markets are down. So principal protection means something that can't go below zero. I'm not going to talk about different options for that, but that just means that you can have some reasonable growth in that investment, but that any given year you can't go below zero. So, and the only time that works against you is when the markets really roar. But even in normal markets, studies have shown that a portion of your investments in principal protection, helps tremendously. The last is account segmentation, and you've heard me talk about this. And the account segmentation tool or strategy is identifying, and this gets driven by your financial plan. And all these things have to work together. The 3 pillars, including account segmentation, but identifies the amount of money you're going to need at different segments of time in your lifetime. And I talked about this quite a bit on on Dave's podcast when we talked about that, because he asked me about, what do you think about this 4% rule, the 8% rule? And I said, they're all bunk. What you really need is An investment strategy is driven by your financial plan. It has these three pillars: principal protection, asset allocation, and account segmentation. And that account segmentation is going to tell you where your needs lie in different times of your life, and that's how you should invest those funds. So if I'm retired and I need $150,000 over the next 3 years, should I be taking Goldman Sachs position or BlackRock's position? Should I be overweighting in AI focused stock in those funds that I need over the next 3 years? Well, probably not, in my opinion. That should be very, very conservative funds, because you want to count on those funds when you need them in that time in your life over the next 3 years. If you need $150,000 over the next 3 years, for example. If you want to invest more aggressively, you do that later out on your timeline. But I'll add that to the list too. So 3 pillars, that gets used a lot, but that's how you overcome this uncertainty. And you get some comfort around, okay, I know where my funds are coming from over the next few years in my retirement. I know that the next segment is going to be available too, because we're taking a little bit more risk in that segment, but that's going to cascade down. And then the following segment, we take a little more risk. The following segment, we take a little more risk, and it all ramps up that way. So not only do you get some comfort and help eliminate that worry of where's my money coming from when I need it, it also offsets that fear of missing out. Because people don't want to miss out on things like, what about this AI? What if this is a big thing? What about this? What about that? You want growth. You need growth. You need growth to overcome things like inflation. I don't know if we're going to hit 2% this year. It's kind of like that, that last 10 pounds that everybody's trying to, most people are trying to deal with. I hope we get it. I hope we get to 2% as inflation for this year, but we'll see. All right, so moving on. Let's jump into our Financial 15. So here we are. This is our Financial 15 segment. So this is our financial planning topic coming off of our webinar, and this is what we call the Financial 15. And today we're going to talk about 2024 IRA and Retirement Plan contribution levels. So these are updates. And what I like about this chart, and I didn't do this. Let me grab this for you. And if you haven't already done so, hit the subscribe, like, and notification button if you're just joining us for the first time on YouTube or have not done this yet. But let me share with you, this chart that I'm going to share with you, as including the chart I shared with you last week, tax bracket updates, and what we're going to talk about next week with Irma and other things. I'll show you where you can get that and download it for yourself. We did just update so the website. So the 2024 updates are on here, and we left 2023 for you because many people want those 2023 charts, even though they're tax planning charts. They want those so they can do their taxes. Maybe they do them on their own, or they want to have a copy of it or something like that. Whatever the case is, we left them up there. So this is how you find them. This is our home page. So I didn't just do anything there. It just scrolls automatically. And if you go over here to this Education and Resources tab, and you pop down and you go to the Slot Corners tab, and you scroll down, you can download this material. Download free tax planning materials for 2024 and 2023. So that's where you find it. Now let's talk about the changes. And you can have it for yourself. With my compliments. And these are from that. So why are they on the Slot page? Because these are Ed's charts. They're great, and I use them. And one of the reasons I like this one is because it's got the prior years in here. So I'm reaching to grab my pen here, and I'm going to be laying down my tablet so I can draw on this a bit. So obviously, folks, these 2 years are in our back door. We're talking about 2024. Now, there is still a potential to contribute for 2023 in your traditional IRA and your Roth IRA, and you have until the tax filing deadline. So that's another reason it's good that we have these contribution levels. You can't do that with 401ks. 2023 is gone. 2023 is gone. We can only look at 2024. But again, for 2023, so let me erase this. 2023, we can still contribute. These are your income levels for phase out for IRA deductibility. That may or may not be important to you. Most people it is. But 2022 is really the only one that's closed out. But over here, 2023 is closed out. So let's first look at contribution levels. So I'm over here in 401ks and 403bs. So in 2024, the maximum contribution, if you're under 50, is $23,000. If you're over 50, you can add another $7,500 for a total of $30,500. So this is less than 50. This is greater than 50 over here, these two. And this is both Roth and traditional. Why is this important? There's a couple things that you'll see. Down here, IRA and Roth contribution. I'm sorry. Let's look at this. We're going to come back to the 401ks in a second. But let's look at these Roth IRA phase-out levels. Now, we talked about this when we were talking about earlier in the webinar, the full webinar. We were talking about backdoor Roth contributions. So the reason that we talk about that is these phase-out exist. Again, 2023, 2022. Well, we can leave 2023 because you can still do a Roth IRA contribution up to tax filing deadline. But these are these phase-out levels. So for a married filing joint couple, from $230,000 to $240,000 in modified adjusted gross income, you have a phase-out in your Roth or your traditional IRA or your Roth contribution levels. That means above $230,000, there's less that you can contribute, and it's there's a formula for that. So it's less until you hit $240,000, and then you can't contribute at all. You can do a non-deductible contribution in a traditional IRA, but you can't contribute to a Roth IRA unless you do that backdoor strategy. Again, very complex, but that'll also be in the comment section. I have a video about backdoor Roth contributions, and if you're single, those phase-out levels are $146,000 to $161,000. Again, modified adjusted gross income. These are IRAs. These are IRAs. The reason we talk about this Roth up here in the 401k is that there are no income limits on contributions. That is huge. If you make $1 million a year, if you make $1 gajillion a year, you can still fully contribute to your Roth 401k. If you make over $240,000 in modified adjusted gross income, you cannot contribute to a Roth IRA. You can do a backdoor Roth contribution if that works for you. A lot of rules around it, but it doesn't matter with the Roth 401k. So one of the things, we talked about a class I'm having tonight. It's a 6-hour class over 2 nights. One of the things that I always talk about, one of the homework assignments is I asked a question, do you have a Roth 401k? Many people know, many people don't know. And that's a critical item that if you knew before how valuable these Roth 401ks could be, because think about it. If you and your spouse are able to save $61,000 a year after tax, that gets to grow tax-free, as long as you meet the requirements, it comes out tax-free. That's money you don't have to worry about that has that potential tax rate risk, that future tax, all of that. You can set that aside and let it grow. There's a lot of benefits around a Roth 401k. No income limitations. Folks, that's huge. And so when I teach this in the class, I'm always surprised at how many people say, I don't know if I have a Roth option. And that's why this is, again, one of those critical items that if you knew it before, you maybe would have made decisions differently. But hey, you have an opportunity to know it now, and it's better to know it now than know it 5 years from now, or maybe even tomorrow. So that's so important. Roth. So these are the contribution levels. So $23,000 if you're under 50, and $30,500 limit if you're over 50. So no income limits. So let's talk. Now we're back over here to IRA and Roth IRA contribution limits. So Roth IRA, remember, has these phase outs. If you make too much money, you can't contribute to a Roth IRA, or you contribute less. But in 2022, there's no option. You have up to the tax filing deadline for 2023 contributions. But if you're under 50, you can contribute $6,500 plus $1,000. Or excuse me, if you're under 50, it's $6,500. If you're over 50, you can add another $1,000 to that for a total of $7,500 for 2023. For 2024, you get a big $500 increase. So you can contribute $7,000 if you're under 50 and another $1,000 if you're over 50 for a total of $8,000 into a traditional or a Roth IRA. How about SEP plans? It's a little more complicated. So I'll read to you the 2024. The SEP limit for 2024 is 25% of up to $345,000 of compensation, limited to a maximum annual contribution of $69,000. This limit also applies to KEOs and profit sharing plans. Catch-up contributions do not apply to SEP IRAs. They still apply to old SAR SEPs. Nobody has those anymore. No new SAR SEPs were allowed after 1996. SEP contributions can be made up to the due date of the tax return, including extensions. For example, a 2023 SEP contribution can be made up to April 15th, 2024, up to October 15th, 2024, if a valid extension is filed. That's not the case with a traditional IRA. So there are some advantages to SEP. One of the new changes under the Secure Act is SEPs also can have a Roth option now. So that used to be a huge drawback, is that SEPs didn't allow for Roth, because this is a lot of money you could put away. There are other considerations. So SEPs can be good for very small companies that only have maybe the spouses working in it. When you add employees, it can get very expensive, because whatever you contribute for yourself as a percentage basis, you have to contribute with those employees also. So unless you want to just max out contributions for everybody, it can be fine. But now there can be a Roth option for a SEP IRA, so that's exciting. So that went up $15,000 of compensation, $15,000 of compensation from 2023. That's a 5, $15,000 of compensation, and just $3,000. So compensation, that's what it can be based on, and then just plus $3,000 of contribution for a SEP IRA. And again, I know this is confusing. If you have questions, here's a good opportunity. If you have questions, you can reach out to us at questions@attleborowealth.com. That's questions@attleborowealth.com. And I'll give you that website one more time that I showed you, where you can download these forms. That's attleborowealth.com, attleborowealth.com. All right, back to this chart. So that's SEPs. Now let's scroll down to simple IRA contributions. Simple IRAs. 2023 is in the rearview mirror for simple IRAs. Those who are 50 or older by year end can contribute an additional $3,500. The catch-up contributions are also eligible for employee matching contributions if allowed by the plan. So 2024 goes from $15,500 to $16,000. Again, if you're under 50. If you're over 50, you get another $3,500 for a total of $19,500. A big plus, $500 for a simple. Simple plans are used a lot by, again, smaller companies. They are anything but simple. And frankly, I would look at a 401k over a simple plan. You can put more money aside, obviously, and I think, my opinion, it's easier to work with, and there are some limitations around investment choices and things like that you should be aware of. There could be some added cost, although that's really come down. So just a consideration, if I was starting a plan today, I would look at a SEP. Depending on the size of the company, I would look at a simple, and I would look at a 401k. Obviously, 401k, you can have a Roth option. 401k, you can have some loan capabilities. You can have pretty robust investment options within a 401k. But these are things to consider. Qualifying longevity annuity contracts, QLAC. For 2024, retirement account owners can purchase a QLAC with up to $200,000 of the retirement funds. I haven't done any of those, and I don't know anyone who has. Let me see if we hit it all. Did we hit it all already? I think we did. So we hit every detail of this chart. That's good. We talked about contribution levels. We talked about phase-out ranges. I don't think we talked about phase-out ranges for deductibility. Let's just go back to here. So this is for IRA deductibility. So again, you can contribute. You can continue to contribute to an IRA past these phase-out levels. And in 2024, that increased from 116,000 to 123,000 is where that phase-out starts. And then it ends at 143,000 as opposed to 136,000 for a married couple. And you can see the increases over here from 73,000 to 77,500 for a single. Where did 500 come from? 77,000 for a single filer, from 83,000 to 87,000 for a single filer, and that's the total phase out. So what does that mean? Anything above that, you can still contribute that maximum amount to your IRA, whichever fits, under 50 or over 50. You just can't contribute. You can't deduct those funds. But that's why it's phase out ranges for IRA deductibility. A lot of people miss this word in that, deductibility, and they say, well, I can't make an IRA contribution because I make too much money. That's very, very true for a Roth IRA. But this is kind of the secret that allows us to do a backdoor Roth contribution, is that you make a non-deductible IRA, traditional IRA contribution, and you directly convert it to a Roth IRA. And the IRS says that's okay. They've said that it's okay several times. And it just looks, I'll just touch on it. So we've got I'm just going to put non-deductible IRA contribution. Goes into an IRA, traditional IRA. And here's your Roth. So you put that money in for this year. You convert it right away as soon as possible so that it doesn't accumulate here and you continue to have a tax deferred growth. And that is really simply a backdoor Roth contribution, because it's not allowed here. If you make too much money, you can't put it directly into the Roth, but you can go over this route and use the back door to get it in there. Yeah, you got to pay attention to, if you have money previously in this IRA, you're going to be subject to you are subject to the pro rata rule, and that can cost you more money than you think. You can suddenly be paying tax. Oh, I'm sorry. You can suddenly be paying that reads pro rata rule. You can suddenly be paying tax on money you're not expecting to pay tax on. So it looks simple. It's not that simple, but that is kind of the method for a backdoor Roth contribution. So that's the chart for this week. Let's see what questions we have. Jerry writes, how would interest rates trigger the holders of 5% CDs to return to equities for investors? Wow. Really great question, Jerry. That's a big question, and that's a good question. You know, folks, it's not just CDs. There's so much cash on the sidelines, trillions and trillions of dollars worth of cash on the sidelines. And what Jerry is talking about is, and maybe that's an exaggeration of trillions and trillions, but there's a lot of cash on the sidelines, including CDs and money markets and short-term treasuries. And right now people are saying, well, heck, if I'm getting 5% in a CD, why would I take any risk in the stock market when maybe I'm getting 6 or 7%? And they're reasonable people. Some people will say, well, I expect 12 to 14% in the stock market. Well, that's great, but don't expect it. But still, the difference is, what Jerry's talking about is what they call the risk premium, right? The difference between what you're getting with no risk, CDs, short-term treasuries, money market, and taking risk in the market. And that has to be broad for most people. Well, the difference being, well, I can get 5% in a CD or I get 10% in the market. That might be enticing for people to start getting back into the market. Jerry's question is, how far do rates have to come down? I think that's what he's asking. How far do rates have to come down? I can no longer purchase a 5% CD. Let's say that happens in June. In June, I don't know what the CD market is today. I haven't looked in a few weeks, but I'm willing to bet that you can still buy CDs today for five and change, or maybe high fours. So Jerry's asking, at what point the CDs have to come down to where stocks, taking your money out of CDs, money markets, and short-term treasuries becomes more attractive to put it in the stock market. Well, the first answer is your investment decisions should be driven by your financial plan. And you should make these decisions based on the timeline of when you're going to need those funds. And then you're not worried about trying to figure out and gaming when you should be moving money from cash holdings to the market. But if you're not taking that tact and you say, okay, I'm going to try to time this and figure this out, I would assume, Jerry, that there's probably some good research pieces around this, but I would assume that when this is just my feeling and experience in this is that if we start seeing 3% sub 3% in CDs and money markets, it's going to be less appealing to people, especially when interest rates are above that, right? So, or certainly inflation. So if inflation's at 3 and your money market or CD is at 3, you're not earning anything. You follow me? There's no, your money, that 3% is worth the same this time next year with 3% inflation if you're only earning 3%. Well, once inflation is at 3.5, you're actually losing money if you're only getting 3. So that's kind of how I look at it, Jerry. But that's a really, really great question. But again, the answer is you shouldn't let these kind of things cloud your mind and make your investment decisions. Your investment decisions should be based on what? They should be based on your financial plan, what your needs are. And I've given you the foundation. You want to build a strong foundation with your investments and your strategies. And that foundation is built on those pillars: account segmentation, principal protection, and asset allocation. And not, all those things, it's not one is asset allocation, 2 is principal protection, account segmentation. They're equally weighted in those pillars. Jennifer writes, I can max my traditional 401k and contribute an additional amount to my Roth 401k. No, there, your elective deferral is maxed. Whether you're, if you're under 50, it's $23,000 for 2024. If you're over 50, it's $30,500. So whether all of that goes in your traditional 401k or all of that goes into your Roth IRA, if you split half in traditional and half into the Roth, that's the most that you can put aside into the plan, or combination of plans. If you have 3 different jobs and you have 3 different plans, the most you can put away is $23,000. The exception being 403Bs and 457 plans. But regarding your question, 401k, you cannot get cute with that, Jennifer. Don't try to max out both sides of your plan. Your plan provider should not allow it. But the where people get into trouble is they have 2 different companies that aren't connected, and they have 2 different plan providers, and one doesn't know what the other one's doing, and they max out both, and then they run into problems. Really, really great questions. Thank you, Jerry. Thank you, Jennifer. Okay, that's it for today. It's 10:55, and if you're in class, I'll see you tonight. I will be at my home office, so we're going to have a different background, but it's a lot of fun. I'm really looking forward to it. Next week, again, we're going to talk about IRMA, income-related monthly adjustment amounts. This week, we talked about 2024 plan contribution limits and IRA contribution limits. Last week, we talked about tax brackets. And that's it for today. Have a great week, and we'll see you next week. And if you're in class, we'll see you tonight. Take care. Have a great night. Great day. See ya.